Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. 12 months ago, Australian coal companies couldn't find a friend. Talk about a turnaround. Now they're delivering record profits off the back of huge demand and soaring prices. I wanted to look today at investing in this space. Not exactly a straightforward proposition, considering the ESG part of the equation. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Brett Reynolds is the Chief Investment Officer of Tiger Brokers Australia. Brett, welcome to Fear and Greed.
Hi, guys.
Broadly, what do you make of the coal companies over the last 12 to 18 months?
Well, we all thought it was a dying asset. It was going to go away. We've got energy prices soaring around the world. Like Europe's in a lot of trouble. We had the Ukraine situation, which has cut off supply. I think Russia was delivering 40 million tonnes of coal a year. The coal price has gone from less than 100 to 250, 400. It's coming back now, but these stocks are still trading as if that spot price is not going to come down. We got New Hope, Whitehaven, Stanmore, Bowen, all up 200 or 300% over the last year. There's no solution to this crisis. These companies are spitting out a truckload of cash.
I suppose the first question is, if you've missed the boat, is there still time to get on it? So do you think that we can keep seeing the sorts of returns in terms of production and sales, which then feeds through to earnings, that we've seen in the last 12 months?
These stocks are starting to get expensive. Like I'm looking at now, like they're trading at 5-6 times PE. Dividends okay while they're spinning out cash. That coal price comes down, you don't want to be in these stocks. BHP's on 4 times. I'd rather a diversified miner like Rio's or BHP. The market got caught surprised by coal.
Yep.
And yes, they're generating a lot of cash at the moment while the spot price is here, but it is starting to come under.
I just want to talk about ESG because it was such a big issue 18 months ago for the industry. Now, obviously, the immediate impact of Russia's invasion of Ukraine, soaring energy prices, has kind of pushed it to the background just a little bit. But this is what we're talking about, coal prices now, is cyclical, whereas ESG is structural. So at some point, those factors will once again become relevant.
Yeah, supply and demand. Yes, we all don't want to use coal longer term. What's the solution? We've got oil prices. They're coming back down now. But we all need oil. Oil's adding to inflation. Coal's adding to inflation. Yes, we all want to be environmentally friendly, but it's not going to happen quickly.
What do you think the coal companies, the Whitehavens and New Hope, Stanmores, Bowens, should be doing with all the cash they're generating now? Should they be giving it back to shareholders?
They are. Look at the yields.
Should they be thinking about the renewables? Should they be thinking about transitioning their businesses?
They know they're a dying industry, so I don't think it will.
Okay, so it's kind of make as much cash as you can as they run down?
Yeah, until we have what's our solution? Solar? I don't know. What is our solution? But as I said, Europe's about to go into recession. The States are probably already in recession. What are we going to do to get our energy prices down? You're looking at food, energy, all those things are inflationary. Raising rates is not going to fix this situation.
Stay with me, Brett. We'll be back in a minute. My guest this morning is Brett Reynolds, Chief Investment Officer at Tiger Brokers Australia. Okay, so that's the coal companies and a fairly unique set of circumstances for them over the last 12 to 18 months. But you've just said over time that it is a dying industry. What about lithium? Because that seems to be almost the opposite end of the spectrum, where certainly if you listen to Elon Musk, it's a boom industry, but he's not alone. There are plenty of people out there saying lithium is a long-term play.
Well, when you can recharge a truck from a battery charger the size of your phone, you realise how important lithium is. Is it going to be? I've heard silicon is as big a component. So yes, lithium at the moment, like you see all your gardeners, no one is using petrol anymore. We're going into a disposable economy where we're all using lithium-powered lawnmowers, leaf blowers. But again, supply and demand. As the demand's there short-term, supply will pick up. Like I was looking at Pilbara, like that's gone from 80 cents to $5. These stocks are getting ahead of themselves. The other day, the big market move, the top 30 shorts were up 6% against the market up 2%.
Right.
People are shorting the market thinking we're going into recession, but there's still stocks. I'm looking at the banks. Some of these banks actually are looking attractive. Their net interest margins are improving. We're not going to have these big doubtful debts that everyone's worried about. This interest rate rise will slow down, but as I said, we would have been begging for a mortgage rate of 6% 5 years ago. The rates were too low. We're going back to a normalised interest rate environment.
So if you're looking, I mean, we've spoken about coal, we've spoken about lithium, and maybe some of these lithium companies are getting ahead of themselves, but you'd agree that they're a better long-term play than coal, for example. Silicon in there. Kind of what other sectors? So banking, you like as an option, and I'm talking about. I'm not a day trader here. We're talking about long-term investing.
I'd be in the banks. I'd be still in resources, BHP, Woodside. When the market rallies, the blue chips go first, not small caps, the blue chips.
Yeah, right.
So stick to your banks, your top 50 companies, start investing in that. We all want to make the money quick. That's in a bull market. In a bear market, you go for the blue chips.
Righto. And then what about things like retailers and tech stocks and healthcare, those sorts of sectors?
Well, we looked at Netflix the other night. Look at Netflix. That thing's down, maybe at its worst, down
40% or something, wasn't it?
Yeah, 40, 50, 60. That's coming back. Twitter, Elon Musk pulled off probably a great strategy there. He didn't have to pay a bigger premium. He played it very well. We've got that. We've got Apple, and that's a benchmark. Google, they're not overly expensive. Netflix as well. Like they're going to grow their customer base. People don't care about advertising. They'll take it.
What about the healthcare stocks? So we have some great healthcare stocks in Australia, obviously led by CSL. Do you like healthcare?
Well, I like CSL. I can't believe our government sold it at the price they did. But yeah, Medibank, stocks like that, they're an industry where you're always going to have recurring earnings. It's not going to fall away. It's not as volatile as the other sectors.
Okay, so Brett, the $100 question or the $64 question, I think they say, don't they? So what are your favoured sectors, even if they're not stocks, just at the moment?
I would still be buying resources.
Yep.
I think the coal stocks, yes, they're still on the run, but I'm a trader.
Yeah, which is different.
For a long-term investor, I would be actually adding to the banks. I'd be buying the blue chips. But what people don't realise, there's nothing wrong with selling as well. Do not just keep buying. When your stock's up 10, 15% in a year, lighten some off.
Yeah, the whole take profit strategy.
We're all trying to outperform an index, but why outperform an index that's down? The index is down 13%. Why wouldn't you, when you're up 15%, that's better than what you're going to get in the bank, sell some and wait and reinvest? Be more active. Move your portfolio around. There's nothing wrong with it. The costs are so low these days. Move your portfolio around. Stock goes up 15%. You've made 15% of your money. What are you happy with having it at 4% in the bank? Move that stock around because your job is not to actually outperform an index. It's actually to make an absolute return. So you want to have as much capital at the end of the day, not say I've outperformed index 5%, but the index is down 20%. That's not a smart bet.
Brett, thank you for talking to Fear and Greed.
Okay.
That was Brett Reynolds, Chief Investment Officer at Tiger Brokers Australia. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and you should always seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.